Hello and welcome to Tax Takes. My name is Gay Proberts-Cam. In this video, we look at the Australian income tax concept of trading stock. As you watch this video, I recommend you have your candidate study guide and mind maps open so that you can highlight and flag your learning materials. So what is trading stock? Trading stock is defined in section 70-10 to include anything produced, manufactured or acquired that is held for the purpose of manufacture, sale or exchange in the ordinary course of business, and livestock. The application of the trading stock definition in various situations is summarised in the core content. You should ensure you know these in detail. Key points to note in this definition are the type of asset does not matter. Whether an asset is treated as trading stock is determined by the taxpayer's intentions. That is, how the taxpayer chooses to hold the asset. So if the taxpayer holds an asset for sale in the ordinary course of their business, then the asset will be trading stock. But if the taxpayer chooses to hold that same asset for use in the business, then it will be either a depreciable asset or a capital asset. How a taxpayer chooses to hold an asset can change multiple times over the period of ownership. There are special rules that apply each time this happens. I'll discuss these later. So what are the three amounts related to trading stock that are included in the calculation of a taxpayer's taxable income? When a taxpayer disposes of trading stock, the sale is included in assessable income under section 6-5. Normally, the amount included in assessable income is equal to the amount received by the taxpayer. However, the disposal will be deemed to be at market value where it's outside the ordinary course of business under section 70-90. The purchaser is also deemed to have acquired the trading stock at market value under section 70-95. The disposal is also deemed to be at market value where there is a change in the taxpayer's interest in trading stock. For example, when a new partner joins or leaves a partnership. However, an election can be made to treat this disposal at cost, provided certain conditions are satisfied. You'll learn about partnerships later in your studies. When a taxpayer purchases trading stock, the purchase is included as an allowable deduction under section 8.1. However, it is important to note that the trading stock must be on hand under section 70-15 for the deduction to be available. The term on hand is not defined in the tax law, but has been interpreted by the Australian Taxation Office to be when the taxpayer has dispositive power, or in other words, the power to dispose of the goods. Dispositive power is determined based on case law. Goods that have not been physically delivered will be trading stock on hand where the risks associated with the trading stock have been accepted by the taxpayer. This is per the Allstate's frozen food case. It is also important to note that if the trading stock is purchased in a non-arm's length transaction for more than its market value, then the cost of the purchase must be reduced to market value under section 70-20. However, there's no adjustment if the trading stock is acquired for less than its market value. At the end of each income year, a taxpayer must calculate the difference between its opening stock value and its closing stock value. The overall difference or movement is included as assessable income or an allowable deduction under section 70-35. There is no real difference between the recognition of trading stock in the profit and loss for accounting purposes and the amounts included in taxable income for tax purposes. It is just how the calculation is set out that varies. For accounting purposes, sales are recognised as income and the cost of goods sold, or COGS, are recognised as an expense. Cost of goods sold is made up of opening stock plus purchases less closing stock. For tax purposes, the cost of goods sold is simply split into two components, one for purchases and one for the movement in trading stock values. So what values are used to calculate the movement in opening stock and closing stock? Opening stock is equal to the closing stock of the prior year under Section 70-40. This is irrespective of the method chosen for the closing stock in the prior year. The methods that can be used to value closing stock under Section 70-45 are cost, market selling value, or replacement value. The meaning of each of these terms is summarised in the core content along with the key cases. For example, per the Philip Morris case, the full absorption costing method used for a manufacturer should include direct labour, the materials used to manufacture the goods, and a portion of variable and fixed factory overheads. One important thing to note about the choice of cost, market selling value, or replacement value is it applies on an item-by-item basis. So each item of trading stock can be valued using a different methodology. Trading stock may be written down to a lower value if it is obsolete or becoming obsolete. Therefore, trading stock can be valued at nil, where it's going out of use, going out of date, or becoming unfashionable. For example, if trading stock on hand at year end will be out of date in 3 months' time, and the taxpayer knows that they are not going to be able to sell that much trading stock before that time, then they can actually write down the value of the closing stock as at the end of the income year. As I mentioned earlier, there are special rules that apply when a taxpayer changes the purpose for which they hold an asset. When an asset changes from trading stock to a depreciable asset or a capital asset, there's a deemed disposal of the trading stock at cost under Section 70-110. There is also a deemed acquisition of the asset as at that time. The consequences of the deemed acquisition are covered later in your studies. When an asset changes from a depreciable asset or a capital asset to trading stock, there is a deemed acquisition of the trading stock under Section 70-30. The taxpayer now has a choice whether the deemed acquisition is at cost or market value. However, whatever choice they make also applies to the deemed disposal of the depreciable asset or capital asset. The consequences of the deemed disposal are covered later in your studies. So, good luck with your studies, and I look forward to chatting with you again soon.